Hey everyone, welcome back to Corporate Dakota, the place where we try to make sense of all those dense corporate filings, and let me tell you the latest one from H2O. Oh, America is quite the read, like a water main break of information that we need to carefully fix and understand before it causes a flood of confusion. Make sure you join our Discord community linked in the description below. It is the best place to discuss these filings and get your questions answered. So H2O America has just dropped its annual report, and after sifting through all the details, there are some key takeaways about where they stand financially and strategically. It is a bit of a mixed bag with some solid wins and some areas that definitely warrant a closer look. A big part of the story this year is a major acquisition they're pursuing. They entered into an asset purchase agreement to buy businesses from Quadvest LP and Quadvest Wholesale. This is a huge move aiming to boost their presence in Texas, especially around the Houston area. They're looking at a base price of over $483 million for the regulated business and another $56 million for the wholesale part. This is clearly a big bet on growth and expanding their reach in a growing region. However, deals like this are always complex and depend on getting all the official approvals, which can take time and sometimes come with conditions. The report mentions they're waiting on approvals from the Public Utility Commission of Texas, and they've even brought in appraisers to set the value for regulatory purposes. Think of it like getting all the permits before you can actually start building a new part of town. Now, regulation is a huge deal for a water utility. They operate under strict rules set by utility commissions in California, Connecticut, and Maine. In California, the Public Utilities Commission, or PUCC, has a big say in how San Jose Water Company, or SJWC, operates. The report details a pretty complex negotiation process for rate increases, looking at everything from water supply costs to infrastructure upgrades. They filed for a significant rate hike in 2024, asking for over $55 million to be spread across 3 years, and the PUC eventually approved a portion of that. It's a constant dance between needing to fund operations and upgrades and getting permission to charge customers for it. Similarly, in Connecticut, the Public Utilities Regulatory Authority, or PURA, oversees the Connecticut Water Company, or CWC. They're using mechanisms like the Water Infrastructure Conservation Adjustment, or WICA, to recover costs for infrastructure projects. The report shows they successfully got approvals for several increases through this mechanism, adding to their annual revenue to cover those important upgrades. They are also dealing with new regulations for PFAS, which are chemicals that have become a major concern in water quality. The US Environmental Protection Agency, or EPA, has issued new rules. And H2O America is estimating around $400 million in capital expenditures to treat for these substances. That is a massive investment and a significant future cost to keep in mind. And for the Maine Water Company, or MWC, the Maine Public Utilities Commission, or MPUC, is the key regulator. They've also been navigating rate case filings and infrastructure surcharges to ensure they can keep their systems running and updated, especially after consolidating their 10 divisions into a single rate structure. Let's talk about the core business water supply itself. In California, SJWC relies on a mix of groundwater, surface water, and purchased water. They're actively working with Valley Water to manage the long-term water supply challenges. Even with voluntary conservation efforts in place as a major reservoir is offline for repairs, it shows they are thinking ahead about potential shortages. The report mentions their reservoirs are at about 62% of capacity, which sounds okay, but they are also seeing their groundwater basin levels drop. This is a critical point, especially in drought-prone California. Down in Texas, TWC is facing drought conditions too, leading to water usage restrictions. They're planning significant investments in transmission lines and storage to manage this, and they've even acquired some new wells to boost their supply. This shows they are proactively investing to meet future demand and dealing with scarcity. Now let's dive into the numbers. The total operating revenue for H2O America was about $800 million in 2025. The water utility services part, which is their main business, brought in over $787 million. Looking at the breakdown of revenue for water utility services, residential and business customers make up the biggest chunk, around $676 million. Public authorities add another $28 million. And then there are smaller categories. What is interesting here is the small increase in customers, about 1,452 more from 2024 to 2025. It's not a massive jump, but it shows steady, albeit slow customer growth. But here is where it gets a little tricky. While revenue from rate increases is up, the actual consumption of water by customers actually went down. This is seen in the negative $7.2 million impact from consumption changes for water utility services in 2025 compared to 2024. This means people are using less water which can be good for conservation, but can also mean less revenue if not offset by higher rates or more customers. The report mentions this is happening in California and Texas. It is important to remember that for regulated utilities, they can often pass on increased costs and even some revenue shortfalls to customers through rate adjustments, which seems to be the case here, softening the blow of lower usage. When we look at expenses, water production costs are a major factor. These include things like the cost of purchased water, power to pump it, and groundwater extraction charges. In 2025, these costs went up by about $19 million compared to 2024, largely due to higher pass-through water costs and a decrease in surface water availability. They're seeing an increase in purchased water costs, especially in California where prices went up by about 9 to 10%. These rising costs are a constant challenge, and recovering them through rates is key to their profitability. Administrative and general expenses also saw a rise of about $20 million. A big reason for this jump was a one-time boost in 2024 from a program in California that helped relieve customer payment delinquencies. Without that one-time benefit, the underlying expenses like employee costs and insurance are still trending upwards. Depreciation and amortization expenses, which is basically the cost of wear and tear on their assets, also creeped up by about $2.4 million. This is expected as they invest in new utility plant and equipment. Despite these rising costs and lower water usage in some areas, H2O America managed to increase its net income. For 2025, net income was around $102 million, up from about $94 million in 2024. That is a nearly 9% increase. This growth is primarily driven by those rate increases in California and Connecticut, which helped offset some of the higher expenses. They also provide what they call adjusted net income, which takes out certain one-time items like gains or losses from selling real estate and costs related to mergers and acquisitions. Their adjusted net income for 2025 was about $104 million. This helps paint a picture of their core operating performance, stripping out the noise from these less frequent events. Looking at cash flow, they generated over $244 million from operations in 2025, a nice increase from the previous year. This is the cash they have available to run the business, pay debts, and invest in improvements. However, investing activities used up a lot of cash, over $520 million, mainly due to company-funded capital expenditures. This is where they're spending big on infrastructure upgrades and new projects. To fund all this, they've been active in financing. In 2025, they raised about $185 million from new long-term debt and another $122 million from issuing stock. This means they are using a mix of borrowing and selling ownership to pay for their growth and operations. They also paid out over $58 million in dividends to shareholders. The company has significant long-term contractual obligations. Looking at their table, they have over $1.9 billion in total contractual cash obligations. A huge chunk of that, over $1.4 billion, is expected to be paid out in interest over the next few years. This highlights the importance of their debt management and ability to generate consistent revenue to service that debt. Now, the risks. This section is always critical. Beyond the usual risks like weather and economic conditions, a major focus is on the Quadvest acquisition. The biggest hurdles are getting regulatory approvals. The report explicitly states that these approvals could impose conditions that negatively impact H2O AMERICA. They can't guarantee the deal will go through on time or at all. To raise also the risk of not being able to successfully integrate Quadvest's business, which could disrupt their operations and prevent them from realizing the expected benefits. Failure to complete the acquisition could also hurt their stock price and financial results. A significant legal matter is the PFA's litigation, H2O AMERICA received over $25 million in cash proceeds from settlements with some of the chemical companies involved. This money is meant to help offset the costs of dealing with PFA's contamination in their water systems. They are also entitled to more payments in the future, but the exact amounts aren't yet predictable. However, they are also a defendant in a class action lawsuit regarding water contamination, which they are vigorously defending. These legal battles and potential settlements are a major financial wildcard. Looking at the management's discussion section, they lay out their strategy clearly: invest in regional regulated water utilities, provide regional non-tariffed services, and explore out of region opportunities. The Quadvest acquisition clearly fits the first point. They're also committed to infrastructure investment, with plans to spend around $458 million in 2026, excluding the Quadvest deal. This shows a consistent focus on maintaining and upgrading their systems, which is crucial for a utility. The PFA's treatment costs are also a big part of this capital expenditure picture. So, what is the story here? H2O O America is a solid, regulated utility company navigating a challenging but essential industry. Their core business provides a vital service which generally offers stability. They are actively investing in infrastructure and growth, with the Quadvest acquisition being a major strategic move to expand their footprint and revenue base. The regulatory environment remains a key factor as they need to consistently work with regulators to recover costs and earn a reasonable return. The rising costs of water production and the significant investments needed for environmental compliance, like PFAS treatment, are ongoing challenges. The financial results show resilience, with net income growing due to rate adjustments, even with lower customer usage in some areas. However, the complexity and uncertainty surrounding the Quadvest deal, coupled with ongoing legal matters like the PFA's litigation, present notable risks. It seems like a company focused on long-term essential services, but with significant execution risks tied to major acquisitions and environmental regulations. What is your take on these numbers and what do they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.